Welcome back to the 301
Welcome.
Club. Remember to like and subscribe so we can teach you how to build wealth in your 20s. And today we have a very special guest.
Yes, sir.
His name is Ari.
Ari, if you
over here
want
in
to.
How's it going, y'all? Thanks so much for having me. Appreciate it. Much appreciated.
Thank you. Thank you
Yeah,
for
definitely.
coming on, taking the time out of your day. Appreciate
Absolutely.
that.
Hey, happy to be here, guys. It's always a good time.
Let's
Yeah.
go.
Let's do it. So basically, Ari's here because today we're going to be talking about paying your loan off, because if you're getting financing, you're going to need to have a lender and you're going to need to have a good relationship with your lender. And there are some things that you need to do to build that relationship with your lender. And specifically, at this point, you already have an offer on the house, and you still have up until the date of ratification to actually change lenders. However, this is highly, we advise against this because it's important, as we mentioned, to build a relationship with all of your team players. And your realtor is number one, second, lender. And
Yep.
so I think most importantly, it's important to understand that mortgage is a separate part of the process and a separate entity
Exactly.
related to the contract, because if you don't confirm everything with your lender, and if your lender doesn't close the loan in time that you've agreed to with the seller, then you could lose some money, right, John?
Yeah, you could lose out on the essentially if you made an offer and they said yes, and that happens. I guess the closing date would be different if they don't line up. That'd be a big problem, and you could end up losing the whole deal. And honestly, that also, I forgot to mention that, but the escrow, you'll lose the escrow too. So if you put down money for a down payment, it'll go into escrow. And yeah, so that's kind of like I guess also separate entity. And essentially, yeah, it's unfortunate, but yeah, it's make sure. I think that's like one of the things to make sure that lines up. So it's important, like you were saying, build a relationship with your lender. And it's also like when it comes to closing costs on the day of, either having it the day of, or working with your lender, providing the money ahead of time. It all goes through the title company, I believe. And so wiring things is probably easier. I know we mentioned that before, talked about that, so that it just makes things quicker when it comes to sending money. You can wait till the last day, which is like signing day, but preferably to get that out the way as soon as possible. And like I was saying, wiring, if time is like an essence, then wiring would probably be efficient.
Yeah, I just definitely wanted to pick the brain of Ari and ask, in your experience, how many times have you seen people not make the deadline for the financing contingency? Meaning, like, there's a date that your contract says that you have to pay your loan, or you have to be able to be financed in time. And so, how often do you see people not reaching that goal, or is it a lot of the time, a little bit of time, or not that much?
Unfortunately, it happens pretty often.
Yeah.
I'm sorry to say, but the fact of the matter is a lot of people set goals for themselves that they think are attainable, but unfortunately they kind of overshot themselves a little bit in that regards. I can tell you just based on my experience, we had to turn a lot of people away, but for other reasons in particular. It wasn't just a matter of not coming up with the funds when it came to due dates. A lot of people that are looking for mortgages in particular are severely inhibited for a variety of reasons. People got to realize there's like a whole myriad of reasons for why you might not get a mortgage. It's more than just that. We've got to account for income. You've got to account for credit. That's a big thing. We've also got to account for if you're in forbearance, if you've got a loan currently and whatnot. We've got a lot of people trying to buy multiple homes and build equity that way. It's wild. And the thing is, when you come across borrowers or potential borrowers who are first-time home buyers, you're going to find that everyone's got a little different degree of baggage that comes with them. It's really interesting.
Yeah, no, totally. Yeah, you hit the nail on the head. Could you define the forbearance word that you just mentioned there, so that our viewers can learn about that?
Yeah, and I just wanted to mention that if it hasn't already been said, Ari was a loan officer, I believe, right?
Yes.
Yep.
Yeah.
So I should mention I did work
Right.
for a couple lenders for 2.5 years, primarily conducting refinances, but for the most part, aside from refinances, yes, I was doing loans for first-time home buyers. It's just that given the market during the coronavirus pandemic, which is right when I got into everything, a lot of people were trying to refinance their homes at that point in time, given how how low the rates were. So to put it in perspective, just when I'm talking about forbearance,
Right.
it's pretty much a deferment on the agreement between you and yourself and the lender. And that's when they sort of postpone your due dates for your loan payments. So every lender has a different regulation or sort of different method by which they go about dealing with forbearance. If it gets too out of hand, then you're subject to, unfortunately, having your home be repossessed. So just something to keep in mind. That's, again, just one of the factors that we've dealt with when it came to refinance products or people who wanted to buy new homes that were looking to do so. It's pretty interesting.
Yeah, definitely.
Yeah, I mean, and just, moving along to the next topic, like building a relationship with your lender.
Important.
In our experience, we at first we actually sent a check in to the tiling company as our first payment with our escrow deposit. But after that, we started wiring our funds to the tiling company, and we noticed that our lender was a little bit more happy with us doing that, meaning that he didn't really have to check some certain bank accounts and look into the past, who is sending the wire, if it's a gift fund or if it's coming from your own account. There's less proof that you have to show to
It's just quicker. I think
the underwriter.
The bank really just wants to make sure that the funds are there, and they also want to source it. So that's one thing. And it makes it easier. I just want to throw it in there for gifting. Like sometimes family is like hesitant to like share bank information. Like if they're just giving you a gift, they're like, "Why do I have to give you bank statements or my bank statements?" Like that is a little. It's like an odd situation to put your family in, but yeah, I think wiring, like you were saying, it just makes everything easier. And you said something about the underwriter.
Yeah, so keeping in contact with your lender throughout the process. At some point, it moves to the underwriter, right? And so, Ari, we wanted to ask you about this because when we were buying our house, we didn't even realize that there was going to be moving on to an underwriter, and then also the underwriter was a lot less vocal to us than the lender himself. So
Right.
Can you explain
Yeah.
the relationship between the lender and the underwriter?
Absolutely. So the thing to keep in mind with regards to the underwriter is the last line of defense to mitigate any risk pertaining to the loan process. So when it comes to something like this, it's unfortunate you're not going to see them. They're not going to be the face that you interact with. You're going to be working with your loan officer for the most part. Maybe a processor if they're trying to collect documentation, and again, John, I can understand why people would be skeptical about all these documents that you have to furnish. It gets pretty wild at some point. Like, why do I have to
Right.
if I'm giving a gift, why the hell do I have to churn out all these documents to prove it? Well, you'd be surprised, ever since 2008, there have been so many regulations put into effect to protect borrowers and to ensure, and lenders as well, as a means to mitigate any sort of fraud and whatnot. But getting back to your question, yeah, you're not going to interact with an underwriter for the most part. They're kind of prima donnas.
Right.
They're not going to want to talk with borrowers, unless they absolutely have to. If they need documentation and a processor just won't get one. But yeah, to answer your question, the underwriters are pretty much, a lot rides on them. They have a lot of pressure on them as far as ensuring that everything is 100% accurate. They have to ensure that all the T's are crossed and all the I's are dotted. And that's essentially their position.
Yeah, no, exactly. And another part of our experience, which I think is pretty unique, is that actually halfway through the process, our underwriter quit the company. So
that was random.
yeah, no, seriously.
Yeah.
And so
That's
what
crazy.
was happening at that point is the underwriter, I guess the processor, was asking us for documentation and things like this. But once the underwriter quit and we got a new one, they were still asking us for these documents. But we understood that when you wire payments, there's no law that says that they have to see the bank statements of the person that you're receiving the gift from if they're wiring straight from their account. So yeah, that was our experience, and I think it kind of helped that the underwriter actually was it changed over to a new underwriter. So if that does happen, don't be surprised, but just roll with it and continue to follow what they're asking for you. But just remember that wiring is the way to go, because
Makes things easier for
Yeah,
everybody.
exactly.
I just want to say there are so many things that can go wrong with a loan process because there's so many moving parts. You don't just have the officer that is going to originate the loan process for you. Then you got the processor on top of that who, like I said, is going to be chasing you around for documents and ensuring that you abide by everything that is required by said lender. And then you got the underwriter that's really going to be nailing in the final nail in the coffin to ensure whether or not you get the loan in the first place. And man, things like that happen all the time. People quit and it's a real pain, or you might miss a deadline and then you have to start all over. I've had that happen before, unfortunately. And I've had to do that with clientele. And sometimes, admittedly, I dropped the ball, or sometimes it wasn't my fault at all. Sometimes people on my team dropped the ball, or sometimes people just up and left the company and then we had to start all over. So if things do go south, I mean, don't be alarmed. Don't get skeptical. Again, I know it's pretty daunting for people as far as that's concerned, but just be aware that the mortgage loan process is fairly complicated.
Right. It sounds like you were saying there was like three parts essentially. There's like the loan officer, and then there's the underwriter, and then usually you said there's like a processor.
There's a processor. I want to chalk it down to three parts because there can be multiple processors, but you also have to deal with the closer. Okay.
Right.
So the person that I assume when you guys met with this, you guys met with the closer, right?
No, we never met in person, any of these people.
Oh, okay. So everything was just done over the phone. Okay.
Yeah.
I mean,
Yeah, no,
email.
we're aware it's like different, and we've talked about that before. Where like it depends what bank you're talking to, and that's kind of the relationship you want to understand from the beginning. Is if they're going to be in person or over the phone, or a lot of their emails, they like emails or texting, those kind of things. So
yeah.
ours was just email, text, and call. That's all we ever.
So you're
saw.
going to find with the emergence of the digital age, unfortunately, mortgage lending has become a little less interpersonal. But you shouldn't necessarily be skeptical because you've got to realize there are a ton of people like inquiring all the time, maybe a little lesser now because of how hectic the market's gotten, but still, people are inquiring even if it's just to inquire. And I mean, coronavirus changed everything also. We've got to bear that in mind as well. So a lot more people are skeptical. A lot of businesses have just kind of transitioned to doing remote work as far as being within the realm of lending.
Right.
Interesting.
So just something to keep in mind as far as what you can expect from a relationship with yourself and a lender. It might be along the lines of that.
Right. I was gonna say like some banks, like when you walk in, they don't really have loan officers like standing around like help, that can help like on site. Yeah, which I thought was interesting.
Some do. Some absolutely do.
Exactly. Some do. And
some for the most part.
That's why we avoided Truist, because they told us to like call the mortgage lender and like figure it out ourselves, and we were like, that doesn't seem like it's going to be a good relationship that we're going to build from that.
And I've heard that from Truist. Unfortunately, they don't have, not to knock Truist or anything, but they don't have the most interpersonal banking connection. I don't think they're not a community bank, are they?
No.
Yeah, and they recently merged with BB&T and SunTrust.
BB&T, yeah.
Yeah. So yeah, just something to keep in mind. Sometimes you'll run into a banker who is a certified MLO. Not always going to be the case, though.
Can you define what MLO is?
It's a mortgage loan officer.
All right.
Or a mortgage loan originator. Those terms are practically synonymous with each other. They're interchangeable.
Yeah. Okay. Sweet. So, I mean, going back to kind of our experience and talking about the underwriter and proving your funds, just to know you are, just be ready to show your funds or your bank account for the past 60 days. The primary borrower should be prepared for this. So if you have one borrower, he needs to be prepared to show his 60 days of bank statements. And this is because they want to make sure that you didn't receive any high amounts of monies into your account that could be perceived as maybe a separate loan, because then the underwriter would have to include that into your DTI, which would change your approval for the loan. It could completely wipe out your approval. So I think a rule of thumb, what our underwriter told us is, just make sure there's no deposit in your account that's double your biweekly salary. And because if you're getting your salary normal, and it shows up in your bank account, the underwriter will think, okay, that's fine. There's no problem with that. But if you're making $2,000 every paycheck and you get a $4,000 deposit into your account and you're paying a down payment of $8,000, how do they know that the $4,000 didn't come from someone that you owe money back to. And this is the point of the gift letters, is that when you receive a gift, the person should be telling you, yeah, you don't owe me this money back, but you need to have that gift letter. However, you don't need to show the bank account statements for that. But if there's no gift letter, that's the point, right? You're going to have to show, you're going to have to explain why you have this so much,
They want
such a high deposit into your account. Yeah.
Right.
Exactly. Just be prepared to explain a lot to the underwriters because they really have to account for everything. They're under a lot of pressure to do so, and it only makes sense.
Yep.
Yep.
Perfect. So, I mean, continuing on kind of like with the underwriter stuff, another thing that in our experience that was a different, well, how should I say this? We're talking about student loans and DTI, how they relate, right? Because right now it's, Biden has just announced that student loans will be forgiven up to 10,000, 20,000 if you have a Pell Grant. And so this is going to actually be beneficial if you're looking to buy a house in 2023 and beyond, because like Ari mentioned, the demand is not too good right now, but if you have a low amount of debt, then you're going to have a lower monthly, a lower rate possibly. And so what happened with us is that first I had a student loan of a high amount, and basically the underwriter will automatically take 1% of that for your monthly payment, correct?
Exactly, yes.
Yeah.
They're pretty lenient when it comes to that sort of thing.
They're very lenient because what had happened was that actually I ended up, in my closing documents, they said I actually only had to owe $130 per month on that. And what the conversation I had with my lender was, hey, your DTI is a little bit too high. We can't approve you for this loan. But he did some things on his own to just, kind of finesse my student loan payment. Right. But I mean, it is kind of, honestly, there's been a moratorium on this, and we haven't been paying student loans, but they want to look into the future, like how much you're going to be paying on the student loan. But like we talked about, it's going to be lowered for everyone across the board if you have federal loans. So,
Right.
yeah, so that's the question that we wanted to ask you. So yeah, how imperative is your student loan debt when it comes to being qualified for a loan?
So first and foremost, you mentioned that the loan officer that you worked with took about, I'm sorry, what was the loan type that you guys took on this house for?
Oh yeah, for sure. We got a conventional.
It was conventional,
Yeah.
and was it Freddie Mac or Fannie Mae?
It was Fannie Mae.
Fannie Mae. Okay. Yeah. So Freddie Mac and Fannie Mae have slightly different requirements when it comes to student loan. When it comes to student loans, when it comes to accounting for your debt to income ratio, but
Right.
like you said, they're pretty lenient when it comes to that sort of thing. I believe. Don't quote me on this, but I'm fairly sure. Yeah, like you said, they'll take at least 1% of what you actually owe for the month, and they'll chalk it up to sort of mold that into what your new student loan payment is going to show up as being on paper. Right. As a means to qualify you, because they acknowledge that we've kind of got a student loan crisis going on right now.
Exactly.
I mean, there's nothing short of that.
Yep.
So I wouldn't worry so much about that type of liability as opposed to other liabilities that you might have when it comes to factoring for debt to income ratios. So honestly, in my experience, it was credit card loans that was really inhibiting people.
Interesting.
Like a lot of people in this country are taking money they don't need to buy things they don't need. And it's staggering. It really is. And unfortunately, most of the people I work with who were trying to get mortgages or refinance, like they had negative net worths. It's kind of crazy when you think about it. But oh man, I don't even know how to phrase it. Like it was so crazy.
No,
but
I mean,
yeah, you should. I'd say if you're prior to going into buying a home, do everything you possibly can to mitigate the amount of debt you have already. Student loans, I wouldn't say don't worry about it so much, to be completely honest. I mean, I'm not saying don't pay off your student loans. Definitely make a conscious effort to do so. But as opposed to other types of liabilities, like credit card debt in particular, or say if you have something outrageous, like if you've got to make payments on a boat or something, then focus on doing that, if anything.
Yeah, or a car. And then, so there's also...
Or a car. Yeah,
there's also
car payments too.
Another rule of thumb, right, which, we want to make aware to everyone is don't open a new credit card once you're already pre-approved.
Yeah,
correct?
That's a red flag for an underwriter. Absolutely.
Yeah,
do not do that whatsoever. Just wait until the process is over and done with, and then you can go on your merry way and like freaking open up like new liabilities.
Yeah, and like, but did you have people who bought things on their credit card, not necessarily opened a credit card, but they just had a credit card and they bought furniture or something right before they're about to buy a home? Does that happen often? Or if you
Every
see that, is
once
that
in
a red
while,
flag?
For the most part, I would tell people up front not to do that.
Right.
So they wouldn't, assuming they were serious about moving forward with the loan process. Rarely ever did that happen. I mean, every once in a while, yeah, it would. But for the most part, no, not so much.
Okay.
Just
yeah.
because, again, as in order for me to ensure that I was a good loan officer and was developing, furnishing a quality relationship with the client, like I had to tell them these things up front.
Yep.
Right. Makes sense.
So I'd say try to find a loan officer that's vocal and is going to give you as much information as possible. And honestly, the best way to go about that is via referral.
Yeah. So we definitely talked about how to find, your loan officer. And we've talked about big bank versus small bank, stuff like that. So, that's a great question. I think I want to ask you, like, which should you go for, a PNC and a Truist or a local credit union?
So this is a great question because I actually, in my new position right now as a small business consultant, I'm working with about 50 plus banks in my territory, which is the Alexandria territory and around adjacent to the Washington, D.C. metropolitan area.
Yep.
So we do work with Truist and we do work with PNC. We have referral partnerships with the two of them. Now, I know we were just touching upon Truist and the merger that they just had recently. Something to keep in mind with Truist is, again, you're not going to get that most interpersonal connection, unfortunately. It's just not going to be there. You might not have somebody to talk to. I have a client right now who's interested in switching to a community bank just because of this in particular. PNC, on the other hand, despite the logistical issues I have with their customer service hotline, I'd say they're pretty good for the most part. They're pretty solid. You can always get somebody to talk to at the very least. And, their rates are, they're okay. Not the worst by any means, but I mean, okay, only one bank in the entire United States is going to have the lowest rates. So again, as far as I'm concerned, PNC, if I had to choose between the two, I'd probably go with them. I'd go with the latter. I'd go with PNC.
Yeah, no, for sure. And they'll also even give you grants and especially special programs, especially when demand is low. It's especially right now, in September 2022, Fed is increasing, the rates, and in turn, the mortgage rates are going up. And I think just this week, they're like the highest they've been in the last 14 years. So different. From what I understand, these bigger banks give incentives, like for example, grants. Or sometimes you don't even have to pay a down payment. Like Bank of America, I know, is doing something about this. Do you want to talk about that?
That was like a thing that was out and like on the internet. But I haven't looked into it too much. But yeah, apparently Bank of America, they're offering, I believe, no down payment loan mortgages, and so that's like something that might be interesting. Yeah, so if that works out and that's actually a thing, I think people can take advantage. I believe there's like stipulations to it. But I'll have to check that. But yeah, it's something that I heard about. So
yeah, I mean, it's a brand new program that's out. It's just an example of how the big banks can do things to incentivize the buyers when the demand is not correct,
right?
And the market's unstable, which it has been during the coronavirus. Like Ari mentioned, the rates have been lowered, but now like I'm talking about, they're going so much higher.
Right.
So
and for anyone who doesn't know, what we're referring to is when global supply chains were broken by coronavirus,
right,
which basically meant that as a result of there being excess demand and not enough supply, you've basically yielded shortages, which has in turn led to inflation, which is why the Federal Reserve has felt inclined to raise rates as a means to sort of mitigate that inflation.
Yep. Exactly. And they continue to do so, and no one knows when they're going to stop. And so that's the tricky part about it. Is something that I would suggest is don't time the market. Just if you're ready, go for it. But if you see programs out there that are convenient for you, ask questions. We have, Ari can attest to the fact that lenders are very vocal. They want to help you out. They're on your team, right? So
something to keep in mind also is the fact that historically, even though rates are higher than where they were 2 years ago, because when the Federal Reserve slashed rates as close to zero as they possibly could, I mean, we saw ridiculous rates. Like I was doing loans for like 10-year terms for like 1.75.
No
it was
way.
unlike, I know, it was ridiculous.
Wow.
It was unlike anything I had ever seen. And now the rates are definitely between I'd say like they're in the 5s, 6s, 7s
Sixes.
even.
Yep.
Yeah.
It's going to be different for, and I want to make this clear. It's going to be different whenever people ask me what the rate is. You got to bear in mind it's going to be different depending on the program and the loan term and what specific product you have. But historically, they're still lower than they have been over the course of the past several decades. I mean, in the 80s, people were paying rates in like the 10s, 20s. Like, it was ridiculous. Wow. It was absolutely crazy. So just something to keep in mind. Even though you might be skeptical about buying a home right now, and I can understand why, because housing prices just keep going up and up.
Yep.
It really depends on the individual. Bearing in mind that interest rates are still historically lower than they have been, if it makes sense for you, I would say definitely consult with an originator. There might be another bubble. Like in '08, we might see housing prices crash if no one's buying houses, and it seems like it might be that way. But again, no one really knows when that's going to happen.
Right.
Even the most seasoned economists have no idea. It's like trying to forecast the weather. You just can't. You can get pretty close, but you can't. So I'd say trust your instincts, but at the very least, be practical and make informed decisions.
Yeah, I mean, and that's where we can differentiate between maybe a residential buyer or someone who's trying to do this to build wealth, right? If you're a residential buyer, you might be more malleable to what's happening in the market, those kind of things, and it might change your opinion and what your strategy is. But like we've talked about, if you're doing this to build wealth, you need a strategy before you talk to your lender, and you need a long-term strategy about what you're going to do with your time. And there's no way to account for what's going to happen in the market. Like Ari said, even the most seasoned economists cannot determine that. So don't waste your time doing that if you're trying to build wealth.
Yeah, I was gonna say making sure you have your money together. If you have any sort of capital that you can put down as like a down payment, I think that all is important. And like working with what you have and understanding how much you have, and then finding a way to find a good loan and whatnot.
Also, I'd say a couple products in particular that have been pretty popular lately would be the Home Ready and Home Possible loan types on behalf of Fannie Mae and Freddie Mac. So just something to keep in mind. Okay, if you've got a credit score between 620 and 680, you can qualify. You might not get the most favorable terms. You're probably not going to. It would help to have a score over 680 and up.
Yep.
But still, you could probably still qualify. And really, your eligibility limits, just so long as you don't exceed 80% area median income for the property's location, including properties in low income census tracts, then that's a pretty good means by which you could go about notching a home loan. The down payment is only 3% for these conventional loans, which is crazy because, okay, for FHA, it's 3.5%, but conventional loan types or conventional loan figures figured, okay, how can we go about being more competitive with FHA? So they've churned this out. 50% DTI is available. Not amazing, but not terrible. There are gifts allowed. And as far as the pros, okay, as I'm sure you guys are well aware, conventional kind of gives you more of a foot in the door as far as securing an offer for a home. When people see FHA, they're kind of just a little bit more skeptical. Like FHA, this is just like, a common loan. There's nothing wrong with FHA, but the likelihood of you getting your dream home is just a little lesser. And these are just marked by market statistics in major cities. Yeah, you're more likely to follow, or you're more likely to get a home with a conventional. You got the lower down payment, which means you won't have to cut into your savings as much. So that helps, but your rate is going to be a little higher. So just bear that in mind as well. But again, Home Ready, Home Possible would recommend if you don't have a whole lot of options.
Yeah, no, I mean, you've heard it from Ari himself, and we also recommend these loans, especially because of because of the option of getting a gift, and that is going to help so much with down payments, closing costs, which can change throughout the process.
So I know we've been talking about the DTI and how that's important, and making sure you have your debt figured out, working on paying that off. I think that's kind of the reason why, to touch base earlier what you said, sometimes like different loans, essentially different mortgages have different standards. And I know when you were working with West Banco, they said, because initially we were going to get the loan with both of our names on it and do like a joint loan, but then our combined DTI was higher, I believe, or lower. I
Our,
believe.
our combined income was higher than the 80% threshold, like Ari talked about, because we were
Yeah.
using the Home Ready at the beginning.
True.
Yeah.
That's what you get for making too much money.
Right. So we figured.
Well,
Bunch of jabronis.
dude. Well, no, but these programs are out there to help people who
Yeah.
are maybe there's different programs out there. If you're making a certain amount of money, there you can find them. So we've talked about this one, especially if you have a lower credit score. The Home Ready, Home Possible is the great option.
If I could just interject,
Yeah.
you guys might want to recommend to your listeners to take the time to shop around, because not every lender is going to have these programs. There's so many freaking lenders out there, and some are not going to be able to do anything for you. Some are going to promise you the moon and not going to be able to deliver that. Some are going to under promise and over deliver.
Yep.
And it's really interesting that that's the case. I work for multiple lenders, and first lender I worked for, I mean, we practically couldn't do much other than we couldn't do anything other than refinances. So I couldn't even originate loans for first time home buyers. And I could only do FHA and conventional loan types for rate and term reductions. When I was working for another lender, the lender that came that I worked for afterwards, I had the ability to sell so many different kinds of products for veterans. We were doing more than just refinance. We were doing loans for first-time home buyers, whether it was FHA, conventional. If we were if we were working within the realm of refinancing, we were able to do debt consolidations to help people use their equity to alleviate them of whatever liabilities they had amassed over the years. We had the ability to get them cash if they wanted to take cash out. So just something to keep in mind. Take the time to shop around. Don't just, even if you get a referral for a lender, do your due diligence and ensure that you've at least talked with a couple.
Yeah, exactly. I mean, this is a good segue into exactly what we wanted to ask you, Ari. Like, so talking about different lenders, they have different packages and they do different things for you, right? To help you get to the end goal of you buying a house. But how much of this job is commission based, correct?
It is.
So how much of that is an influence on you helping someone get a loan or yeah?
Again, it really depends on the lender and the culture that they've instilled in their employees as far as loan officers are concerned. I don't know how it works for processors or underwriters. I wasn't a processor or an underwriter. I wasn't a closer or anything like that. I can only speak to the experience of having been a loan officer. But different companies are going to have different incentives in place, which are going to instill a work ethic in an employee. And it really is amazing. Admittedly, the first job I had as a loan officer was my first real job out of college. And admittedly, it wasn't a place that I wanted to be at long term. The incentives just weren't there. And typically, as far as commission structure is concerned, the industry standard is 1% of whatever volume you closed that month. But some lenders are a little more lenient. They might just give you some figures as far as, okay, if you closed X amount of loans, you get X amount of commission. I kind of prefer the latter commission structure. And I was fortunate enough to get that when I worked for the second lender that I spent my career in mortgage in. But it was more than that. It was a matter of core values. It was a matter of the culture and camaraderie amongst myself and my colleagues, even though we were working from home. And that's what made it so freaking amazing. So it's really dependent on the lender. There's so many factors that come into play, because like a lender is just like any other business. No two businesses are exactly the same. They're not going to be universal whatsoever. It's not cookie cutter-esque. It's just, they're all going to be diverse.
Yeah. I mean, speaking about diversity, I mean, we haven't touched on it because we are not a member of this class, but for veterans, I mean, do you have any experience giving loans to veterans?
Absolutely.
And is there a difference being a veteran versus not when it comes to down payment, credit,
Yes.
And rate? Stuff
Absolutely.
Like that?
You have every benefit in the world if you're a veteran, when it comes to mortgages, at the very least.
Yeah.
But yeah, what's amazing is you can get 100% financing. There is no down payment. You have access to the lowest interest rates. If you're looking to refinance, you have the ability to streamline, which will forego the need for any credit, income, or asset documentation. There is still the need for an appraisal, though. And the VA can get a little touchy as far as what they want your house to look like. Like, say, if you have a broken window, you might need to fix that before you're eligible for a VA loan. But other than that, other than little nitpicks that the VA likes to put the veterans through, I mean, it's pretty cool. You have access to the best products whatsoever. And if you're facing foreclosure, the VA will negotiate on your behalf with a lender if you're looking to, if you're in that unfortunate predicament. Mm-hmm. So something to keep in mind. I also want to say, if you do receive VA disability, then there is no funding fee that comes with getting a mortgage. So, and VA disability is actually pretty easy to get. So for instance, one of my friends, he's a veteran, and his arm kind of like pops out of its socket every once in a while. It doesn't really hurt him. It's not broken or anything. But yeah, when he got his mortgage, like, he didn't have to pay the funding fee. It's kind of funny. And awesome. Yeah, they also give him like disability benefits every month. So like, I'm sure that helps pay the bills.
For sure. Mm-hmm. I mean, it just goes to show that, I mean, whatever position you're in or whatever your physical ailments are, right, you can buy a house and start building wealth, and at any age too, because like Ari just mentioned, there's programs out there for veterans for zero down payment. Bank of America giving zero down payment loans. Depends on the market, right? But it also is highly, also your mindset is a very important is a very important tool to bring to the table. And I know, John, we wanted to...
I was gonna say, like, I think like you were saying, anybody and like any age essentially can get a house essentially, but they have to have that mindset, like you were saying, and also, the means to do it, the money. Like, you can definitely, if like you're working retail per se, you're making like so much money.
Like 30, 40 probably, 30, 40K.
A year, yeah. And then like if you work your way up, maybe you get like an assistant manager position, you'll probably make a little more. So there's like things that you can do to like put yourself in a position to, be able to have a little bit more income, save that, and then use that money after you've saved over time. It's a down payment for closing costs. And you don't have to go big. Like, you can get a condo for, I know it depends on where, but, under a certain amount of money. I'm sure it'll be under like $300,000 or an apartment. So it's like, keeping all those things in mind, having a mindset, trying to figure it out. So like, I think that's doable for sure for people that are in, maybe they're just working retail jobs, or they're full time, whatever it may be, maybe get a second job. So it's things like that. I think anybody can has the ability to essentially do something like that.
Yeah, I could just interject here. Something to keep in mind, like you said, you don't have to go big or go home. I mean, you should strive to, absolutely. But if you are looking to buy a house in the near future, as soon as possible, something to keep in mind is for FHA, it's just 3.5% down payment. I would encourage people to make a little bit more if they can, as a means to have a lower mortgage payment. Mm-hmm. But if time is of the essence, it's not going to hold you back too much. And contrary to what people think, if you're going conventional, don't put down 20% just to save on mortgage insurance, especially if it's just another extra $100 a month. Just don't cut into your savings too much. Your mortgage insurance is going to fall off eventually anyway. I don't know if people have told you guys any of that, but you probably know. Yeah. Once you reach 20% equity, it's going to cancel out. If you're at 22%, it falls off automatically. I should mention, at 20%, you can request to be canceled out. If it doesn't happen, then wait till you get to 22%, and then that just falls off automatically. This notion that you have to put 20% down is archaic, guys. Mm-hmm. So again, if time is of the essence of you and you're really ambitious, then by all means, you feel like you can trust your instincts and pull the trigger, then by all means do so. But yeah, I honestly believe, despite all the hardships that younger people have to go through financially, you could still buy a home. I'm not here to tell anybody that they can't. It might not be the dream home that you've always wanted. We got to be practical. We have to be realistic. But I do honestly believe that people can achieve said American dream as far as being able to undertake the venture of securing their first home at the very least. That is still a distinctive possibility. I very much believe so.
Definitely.
Yeah, I mean, I think, not having the capital is not going to be a deterrent to getting a loan. I think maybe the most important thing is having job history. So, for example, we were told that, staying in your job for 2 years is like a must do before you buy a house. Like, it's going to be a lot harder if you have, 1099 income, or if you don't have consistent income that you can prove to the bank, because that's the process you're going to need to start doing right after your pre-approval. And yeah, all you really got to do is you need to convince the lender that you can pay it off, and however that is, with your credit score, capital you have in your bank, or you have a good job. So many
focus
different
on building
ways.
your credit.
Yeah.
Do everything you possibly can to mitigate your liability intake. Try to alleviate yourself of any credit cards or car loans that you have prior to going into this process. Because even if you don't have a whole lot of assets and savings, like you said, people are under the impression they need assets and savings in order to qualify. You don't always. You'd be surprised. You don't. Sometimes it just helps to have a decent amount of income. Mm-hmm. I've seen people with incomes of 30 to 40K, like you said, working in retail with a couple years of job history, W-2 people, and they're still able to notch a home loan because they don't have any debt or little to none. It doesn't mean that they're astronomically rich. It just means that they're fiscally responsible.
Yes. Convince your lender. All right.
That's pretty epic.
So, any more questions for Ari off the top of the head?
You covered like having that good job history, and that's pretty amazing that someone making 30, 40K can secure a home loan. Like, that's pretty awesome. I think that gives inspiration to people
It's
out there.
still possible.
It's still possible.
It's harder now, but it's still possible.
Yep.
Right. Yeah, that's awesome.
All right, well, that brings us to the end of the episode today. Thank you for watching.
Thank you.
We have a closing video coming up in the next episode, so if you would like to see it, tune in and comment and subscribe. Also, like the 301 Club, like the video.
Yes,
Thanks,
sir.
all.
Thank you for watching.